So to finish up the notes here for chapter 7, one of the things I wanted to draw your attention to is the fact that there is a new standard that has come into place over receivables within the past, I think it was 4 years. It was supposed to come out in 2020, but then the FASB delayed due to the pandemic and all the things that were going on already with businesses. They didn't want to impose a new standard as well. But basically, what changes is very much in all the receivable accounts, but primarily in receivable accounts that are held by banks and financial institutions. So let's talk about what changed. Prior, basically, we were only required to record write-downs on receivables, especially the ones that are commonly held by financial institutions, if there was probable cause to suggest that we weren't going to be able to collect our money. And also part of the prior guidance suggested that basically we could use historical records, and that was sufficient to estimate the provision for bad debt expense. This part applies to trade receivables as well, the accounts receivable we've been talking about in recording. So basically, past used to we used to believe that past was sufficient, and we didn't have to worry about forecasting. One of the hallmarks of the CECL standard. And CECL, by the way, stands for Current Expected Credit Losses. So one of the hallmarks of the CECL standard is still holding on to an analysis of the past, but also complementing that with a forward forecast as to what the company's customers' outlooks look like, given perhaps the swings in economy, the movements of interest rates, things of that nature. So, like I mentioned, banks are going to feel the brunt of this because there were a lot of assets that were not required to have an allowance for credit loss, but now will need to. And those include held to maturity securities, which are the debt of other companies that I've bought as an investor to receive interest payments and repayment of my investment in the future. Notes and loans receivable. So any loans, obviously, banks are a huge part of that. That's a huge part of their asset makeup. Reinsurance recoverables in the insurance industry, and basically other types of receivable investments that were held by those companies. Um, and again, before it was only required that we recognize a loss in the value of these items if it was probable that we expected some sort of disruption to our ability to collect payment on that investment. But the new standard is telling us that even in remote instances, so basically it went from probable cause to even in probable cause to expect they're going to default to even remote instances with that they might default. And we have to consider the entirety of the instrument's life until maturity. Maturity means when I'm getting my money back. And for certain instruments up here, especially the held to maturity securities, this could be the next 10 years or even 20 years until those items mature. So forecasting reasonably until the end of the asset's maturity, that's going to be a pretty tough sell. It's going to be a lot of cost to project these estimates. And so this is a pretty big standard. There are implications to the trade receivables that we've been looking at. And so remember, when we say trade receivables, we mean basically receivables from our the provision of goods and services. Basically our business model, what our operating activities involve. That's where trade receivables arise. So these are with our customers. And the way that it affects the receivables we've been recording is basically that now we have those forward-looking pieces we have to incorporate about our customers. The task isn't quite as daunting for a trade receivable because unlike the items that were affected in the financial service companies, remember that trade receivables, their maturity is expected to be typically like 2, 3 months. So almost always less than a year out. So that foreseeable future forecast, not so hard to wrap our hands around as to say forecasting 10 to 20 years in the future. But we do want to incorporate that forward-looking information, even if it is just for a year. We can also, of course, still complement that with the historical records. That's how companies did so in the past and applied bad debt expense. But even though they were required to be assessed for bad debt expense, even just using the historical records, this inclusion of the forward-looking estimates will likely increase some of the bad debt expense we see, but very much so in banks, insurance companies, and other and other companies that play in that field. So let's also talk about a couple of vocabulary changes you might see. One of the new ones that I've been incorporating slowly, and even I'm a little bit resistant to it, is the allowance for credit losses. And that replaces what we know as the allowance for doubtful accounts. And it's even still in a lot of my documents. I mean, I grew up, was a student, and this is what we called it, the allowance for doubtful accounts. So it is deep seated in my brain, and it's going to take a while to get out. You're probably going to hear old timers use ADA still sometimes, especially when they're just speaking informally. But when we are more professional and in a balance sheet financial reporting mode, then you're going to start seeing allowance for credit losses used instead of the allowance for doubtful accounts. The other renaming, which I've had even more problems given up, instead of calling it bad debt expense, which is again something that's been around forever, they're calling it credit loss expense sometimes. So these are the sort of updated terms for the CECL standard. And, it might even be the case that if really all you have are trade receivables, they still might use these two terms. I'm not exactly sure, but definitely these are the updated terms that are mentioned in the new CECL standard. So let's just look at one more example here. This kind of ties everything we talked about with receivables together. Um, walks us through a month in or I don't know, actually it's a year. And so it goes through a whole year of operations in the company, just makes the standard journal entries to accounts receivable we've been talking about, and then includes the adjustment for bad debt. So whenever I'm working a receivables problem with multiple transactions going on, I always default to um, creating a T account for my accounts receivable and a T account for any of my allowance for credit loss, which I'll write as ACL here, even though the problem still does say that. Right? Same thing. Accounts receivable, $200,000 debit balance. Allowance for doubtful accounts, allowance for credit losses, $25,000 credit balance. And with these, I'm going to start recording them directly into the T account instead of working through a journal entry because it doesn't ask for any journal entries. So if I don't ask for a journal entry, you don't have to give it to me. You can just take them straight to the T account. Sales revenue was 800,000, 80% was credit. So apply the 80% to those sales and I get that 640,000. So that would be a debit to my accounts receivable and a credit to sales revenue. Cash collections on accounts receivable amounted to 580,000. It doesn't mention any discounts, gross net method, so we can just record that as a normal cash collection, debit cash, credit accounts receivable. 40,000 was written off as uncollectible. Remember, so when we actually identify an account and it's no longer just an estimate, right? It's no longer just an estimate that we're holding a reserve for, but it's a reality. So we have to get rid of that customer's account. They're not going to be able to pay us, so we don't expect to receive it. We credit their account for 40. The debit is to my allowance for credit losses because now it's no longer a part of my hypothetical. This was the loans that were still out there. That's right, the loans. Well, I mean, it is a type of loan, but basically, these are our customer accounts that were still unpaid, um, that we suspected would be bad debt. Well, now that we found it, we take it out. 10,000 was collected on an account that was previously written off. So we actually collected, and the account was previously written off. Because it was previously written off, what we have then is a reinstatement and collection going on here. Sometimes they'll just reinstate the account and then the customer will pay later. Sometimes it's just all in the same transaction. And when that occurs, we will just be crediting the allowance for credit losses. And the way that happens, if we look at what the reinstatement entails by itself, we debit accounts receivable, we credit the allowance for credit loss. So we add that customer's account back, and it was 10,000 in this case. And since that customer wasn't the bad debt, I want to put them back in because when they were originally written off, we took it out of our allowance for credit losses. So we put that back into our allowance for credit losses. And then when they pay us, it just becomes a simple cash collection where I debit cash and credit the receivable that we had reinstated up here. Well, the debit to AR and the credit to AR cancel out. There is a debit to cash, but we're not really worried about the cash account right here. And so the $10,000 credit to ACL is the only thing that actually ends up a net effect, right? We could write 10 here and 10 here, but it would just be wasted ink. Okay, so now we got everything set up. We have all the entries that would be recorded in step one. We posted them, coming up with the unadjusted balances of these accounts here. So that's 840,000 receivables and 620. So 840 and 620 would be 220. Those are the amount of receivables I have remaining. And then my ACL 25 wrote off of 40,000. That's 35. We still have a $5,000 balance in my ACL. So remember, when these are debit balances, remember this is my unadjusted balance. When the unadjusted balance is a debit balance, what that indicates, or the best interpretation of that, is the provision for the accounts I thought would be bad of the 200 that I had recorded at the beginning of the year. This $25,000 amount was not enough. It was actually, we basically understated write-offs, right? We only had a $25,000 reserve and we ended up writing off 40. And then we recovered one, right? It got reinstated and recovered, but that still wasn't enough to offset the amount of write-offs we had this period. So we have a $5,000, kind of like an underestimate of bad debts. Now that's going to affect my adjustment going forward because basically this adjustment will become padded with our underestimate. And I'll show you what I mean by that. So first we got to get what our desired adjusted balance is going to be. And if we take 5% of outstanding receivables, then that's going to be my estimate. It'll just take 220,000. No aging schedule. This is just a 1% of application. That's 11,000.